Fed's gonna cut. We all know that. But they say that's just going to shine all the negative reasons why the Fed's cutting. Yeah, the Fed cut may be good for stocks for a minute, but then you're going to come to realize that the reason they're cutting is because growth is bad. And that's going to supersede everything and weigh on stock returns.
Yeah, look, I worked there for a long time. A lot of these people I'm quite friendly with. I would just say
you don't work there anymore.
Yeah,
so
look,
you can call them out if you disagree with MAP.
If you're really making calls like that,
give
unfortunately,
me the disclaimer line.
Yeah, no, fortunately, I don't have to do that anymore. But I would say you're always going to, if you do it long enough, you're going to be bearish and right, bearish and wrong, bullish and right, bullish and wrong. That's how it is. I disagree with the call. Also, I'm with Joe. I think it comes down to earnings, and I think if you looked at the note and I read it, certainly some of it was a long note, but they're saying that earnings expectations are way too high. And look, earnings expectations are always too high in the out year. If you look back...
And valuations.
If you look back over the long term on earnings, though, analysts think it's 14% growth 12 months forward, and the actual has been around 6. So I don't really care that next year's numbers, I think, are 11.5% expectations. All I care about is, do I think earnings are going to be higher next year than this year? If they're higher in absolute terms, I don't see I should get crazy negative. I don't. I got a 2% buyback, a 2% dividend yield, a call option on earnings growth, maybe some M&A. Isn't that better than a 2% 10-year, or I have to pay France now for 10 years? I mean, I don't know. I look at the world. I don't see U.S. equities as a below-average investment.
What do you think, Shannon?
I mean,
good call, bad call.
I think that it's too much. I think that neutralizing your equity position at this point in time, probably not now, actually, probably 8 weeks ago or so, is probably the best call if you were really looking at it from a valuation perspective of the fourth quarter versus the first quarter and looking at where we were from a cyclical perspective. I think that now again, I do want to agree with Joe. I don't think that with the Fed taking the stance that they're taking right now, fixed income is not that attractive. And so I would say a neutral stance with, some potential overweights and underweights within your equity exposure. I mean, you can de-risk your equity exposure without going enormously underweight equities. And so I think that from our perspective, adding something like preferreds gives you some, equity-like exposure, but also, gives you a little bit of yield. Those are ways that you could potentially insulate yourself rather than making this binary call on going very underweight equities at this point.
I was just say on your valuation point, to get back to that, a while back I got a bunch of people together and I said, tell me something you want to know a year from now. And everyone gave me their list, 2s, 10s, front end, unemployment. I took all that data, I backwarded the market, and I showed I only have a 50% chance of knowing if the market multiple is going to expand or contract a year from now, even if I have all that information. You don't want to play the valuation game. You want to play the game, do you think earnings are going to grow, and do you think they can surprise to the upside? If that's the case, the current valuation level won't matter.